estate isn't just going out and buying single-family residences. It's not like you could go out and you could do private placements, which is when somebody puts a syndication together. You're going to see a lot of those. Ryan Gibson's one of those. Neil Bawa does those. Michael Sony does those. The guys you're going to learn, this is what they do for a living. They put together groups of people. They buy properties. They leverage the property. They fix up the property. They make it perform better, and then they sell it at a profit. That's what those guys do. And we're going to build up another portfolio there. As you're doing it, there are publicly traded real estate companies. For example, Eric went over Federal Realty and FRT. Again, that's a retail fund that has been paying increasing dividends for more than 50 years, and they got the snot kicked out of them during this virus because everybody thinks, oh, there's going to be defaulting retail. 50 years they've been increasing their dividend. Do you think they may know something about downturns? Do you think they may be liquid? Yes. There's something called cash free flow that you want to be paying attention to, which is the ability of a company that makes profit to not give it all out to its shareholders. So for example, if I make $1 and I give my shareholders $1.30, that 30 cents had to come from somewhere. It either came from past profits, or I raised capital, maybe I did bond offerings or something. Cash free flow is how much earnings did I make? I made $1 and I gave 50 cents to my shareholder. That would be 50% cash free flow. And we like that figure right there. If you make $1, pay half of it out. Fantastic. So you're always keeping some liquidity. That's what we look at with some of these companies. But anyway, you could go to the route. You could go and directly start buying real estate. Here's the deal with rental real estate. Love rental real estate. You got to buy a few because there's an average. In other words, if I buy one house and then it goes vacant, I'm probably not going to be too happy. I have 100% vacancy. If I have 10 houses, I know what the average vacancy rate, maybe it's 4 or 5% in a particular area, then I know that, hey, once every 2 years I'm going to have to worry about a vacancy. And that's about right. You never know, but you want to make sure that you have something to give an average over. So when you start going down the path of single-family real estate, make sure you're committed to buying more than one property. Otherwise, you might be disappointed. It's much better to spread yourself out, either investing through others or going through a fund or going to a REIT. If you want to learn real estate and you intend to buy a house a year or something like that, by all means, you're going to learn way more doing single family, and just make sure you have some buffer built in there in case you become, that 10% happens to be in your first year, right? And then last but not least, this is managed money. This is protect yourself from yourself. Have somebody managing about 30% that you can watch, that you can talk to make sure that it's not just you managing all your money, because if something happens to you, your family may not know what to do, or it may be a bad time or something. We want to make sure that you don't have all your eggs in one basket. So 10% would be cash, 30% would be dividend stock, 30 in your risk stock. If you like to trade, that's where you put that. You don't take it someplace else. 30% in real estate or real estate equivalents. It could be private placements, REITs, etc. And then 30% in some sort of managed money. Now, you don't have to have it actively managed if you don't want to, but I would still mirror a portfolio at a minimum. Like if you are just Mr. Control Freak or Miss Control Freak, and you can't stand have anybody else touch your stuff, at least look over somebody's shoulder and see what they're doing. And there are ways to do that. You could always just give them a little bit of money and then just watch whatever they're putting it into and talk to them and duplicate it. I don't think, I'm not going to gripe about that. I'm not a financial guy. Eric will probably hate you, but Eric McShane, there's lots of people out there. We're not going to sit there and beat you over the head and say you have to go one way, although we do like the people that we work with because they're fiduciary. All right. Infinity investing starting point. The first thing we're going to do is we're going to start off with dividend stock. We're going to accumulate 100 shares. You're going to invest $9 of $10 until you have $50,000 total invested, which means means you're going to have a little nest egg coming aside for your cash opportunity fund. Why are we accumulating 100 shares of a company? Type it into Patty if you know why we're accumulating 100 shares of one company. This will be fun. See how many of you guys are awake out there. It takes them about 20 seconds, Patty. There's a slight delay.
Calls to do options.
Options.
Sell options.
You guys have been paying attention.
Selling
You're
options.
rock stars, because there's only one way to learn to do something, and that's to do it. Paper trading is great. There's some accounts that let you paper trade, but it's not the same as having skin in the game. You will learn so much more if you put money into it. You will learn infinitely more if you do your own money. So you buy shares of a company until you have 100 shares, and then you sell a call. And it's going to be so much more real than reading it out of a book or pretending that you're doing it on a computer. You will start paying attention. Your memory gets triggered, and all of a sudden you will remember that scenario. And if you do it right in the beginning, you'll never learn to do it wrong. It will be etched in you. That's why it's so hard to break bad habits. If you learn to do it right, then you can duplicate that over and over and over again. You're going to build up a cash opportunity fund. By the way, if there was one thing I could say about this pandemic, it's called keep your powder dry. It's be prepared. There is a ton of opportunity out there. Ton of opportunity. And it's not even upon us yet. There's still going to be plenty of opportunities because we decided to shut the doors on commerce, and there's going to be ramifications for it. The next thing you do while you're doing this is you follow our 7 criteria for investing in a company. Eric alluded to it, but we actually go through 7 criteria. It is in our basic section. If you want to have tons of videos going over the 7 criteria that'll drill it into your head, you go on in, and McShane teaches it, Eric and I teach it. I go over a bunch of companies. There's videos of me going over companies that you'll be shocked when you look at when I went over those and where those companies are since I went over those. When I give you a 7 out of 7, take a look at where those companies are now. We update a spreadsheet for you inside that basic area every week. We are constantly rolling, so we do a quarter of the sheet every week, rating them. When you see that 7 out of 7, that is a hint that may be something that you really look at on that particular day. You go through the charting, you go through the education in there. You're not going to hurt yourself when you're looking at this. Now, it doesn't mean that companies don't fall. Federal Realty Trust got hammered. And you know what you do? You sit back and let it pay for itself. If you have a PE ratio, for example, of 15, that's how many years before that stock is free for you. It's paid for itself. It doesn't cost you anything. That's how its earnings will for itself. And you sit back and you wait for it to recover. So if you're ever in a situation where your company takes a dip, all right, don't sell options on it for a while if you don't want to. If you sold a bunch of options and your basis is really low in that stock, go ahead and do it. But if you're like, hey, I bought something, I sold the last session, I sold the put on Coca-Cola, I think for 46, and I made $1. So I got Coke put to me because it went down to 45. So now I own Coke, but my actual cost is 45 because I got $1, right? I could turn around and sell the $46 call and make another $1 and I profit. But I didn't really want to. I really want it to be higher, so I'm going to let it bounce around, come back, and I'll sell options at some point when I feel like it. But I'm just going to let Coca-Cola in the meantime kick out a dividend. You're paying it, increasing those dividends. So like when I say increasing dividends, that's like increasing your rent every year for 50 some odd years. Could you imagine a rental property where you said every year the rent goes up. And for 50 years straight, doesn't matter what's going on, rent went up 10%, 15%, every year for 56, 57 years, that's Coca-Cola. Every time you hit 100 shares, you write options. And as that option, as Eric was showing you the charting, one of the most fun things you could do is when you sell an option when it's high up in the range. You saw those Bollinger Bands. There's other, Marquet does a fantastic job in her class where she does advanced charting. When you are towards the peak of that is when you sell the option, and then you buy it back when it starts to dip back out. And these things will stay in that range usually in a 1 or 2 day period. So you might sell an option, you might buy it back for half, and then it goes back up, you sell it again, wait a couple days and you buy it back. We have people that actually do that on a daily basis because the stock does this throughout the day. We had one gentleman here, clears over 7 figures a year. He's sitting right at in one of our classes. He was trading the whole time. He was having a fun time. He actually lives here. Good dude. Once you get to $50,000 in the first category, you move to the second category. So we do $50,000 here, and that seems like a lot, but we're letting it compound, we're letting it grow. Once you hit 50,000, then we start here. Why am I starting with dividend stocks, by the way? Cheapest thing to get into. I could buy dividend stock tomorrow. Did you give them the Robinhood? All right, so you guys know that Robinhood link to me is not valueless, or is not valuable. Usually you get a share and then the other person gets a share. You get the share, they cap you at $500, and I give that link out to lots of people. So it's not a, Toby gets a share. Toby's way beyond getting a share. But you get a share. You get a free. It's probably going to be like a $3 share, but it gives you a company that you can then dig into and use as your learning. All right. We get our 50,000. So for our first step, this is what it looks like. $9 here, $1 here. Keep doing it until there's $50,000 in the orange. Once you get that $50,000 in the orange, do the same thing on the real estate. $9 in the real estate, $1 in your cash. You always want 10% in your cash. It's going to save your kahootie at some point along the way. The more, like if you have a little cash pot, again, maximum 10% of your assets sitting there. And if you feel like putting it into gold or something that you can turn into cash, I'm not going to cry about it. You want it something that's pretty liquid. If you do a CD, I might, well, I guess that's not even horrible, possibly. I'm not a big fan. They don't pay you much. How much a CD pay nowadays? Less than 1%. Yeah, do a money market instead. You're absolutely right. I think they're paying you like 0.3 or something. It's nothing. Remember, you can borrow money at 0 to 25 basis points. 0.25% in English. All right, then you allocate $50,000 to REITs, private placements, single-family residences, and don't worry, going to bring you a ton of opportunities. That's what we do. We are a group, and we look for group opportunities. When I buy packages of houses, they're usually in packages of 20 to 30 properties. When Aaron is doing it, same thing. He's buying a lot of onesie-twosies. When I'm buying them, I'm buying in groups, and I have no problem sharing those out with the group, saying, hey, I'm going to buy a bunch of these. You guys want in? Michael Sony is usually buying in groups of 100. I think he did the last one, it was 114. When he bought for his fund, 100 would go to the fund, and he'd have 14 extra properties that he would kick out. But since they were buying as a group, we would get the same pricing. And what you're trying to do is find the turnkey. Here's the median asking rent for vacant rental units. You could see it's gone up even throughout the recession. Here's the start of the recession. Here's the end. Went up. Right now it's a little bit flat, but it's going to keep going. You could just do your trend line. Here's the other thing, vacancy rate. I threw in the homeowner vacancy rate, how many houses are bought where they don't live in it? Not very many, less than about 1.5%. Look at the vacancy rate over the years. We need more houses, guys. That's what that means. It means the vacancy rate is continuing to decline nationwide. And you're throwing in, you're averaging in places like Detroit where there's areas where nobody will live. Then you look at the median asking price for vacant sale price. You're still seeing things go up. So vacant for sale units you saw during the recession, look what happened. You had a ton of inventory and they sat around. Oof. Going up like a lightning bolt. So you do that until you have 50,000, 50,000, 10,000. Well, actually, this one would be, 10,000. And then you move to the next category. And that last category, again, is you're either going to do a managed portfolio or you could do a risk analyzer. Eric does those too. I don't know how you feel about that. I know that McShane gets kind of like, he'll sometimes give him what the portfolio will look like in the beginning. You can do whatever you want with it. Yeah, he does risk analysis and shows the breakout. You ever use that tool? Yeah, so he uses something called Riskalyze. I'm having a conversation with Eric. You probably can't hear his response, but Riskalyze is what a lot of professionals will use to get your actual risk number. In other words, they don't want to know, are you aggressive or are you afraid of risk? They want to know how much would you risk. In other words, that's very subjective. If I say, oh, Eric, I'm very aggressive, and he says, oh, that means that you're willing to risk everything you got to make a 20% return. And I'd go, no, heck to the no. I'm willing to risk $10,000 to make 15. Right? That's much different. Hey, if I thought I could make a nice chunk of change, I'm willing to risk a little bit. But let's not be crazy. You don't want to use words when you could use numbers. In numbers, we use numbers. And so Riskalyze is a question and answer thing that they send you. You do this, hey, how much are you willing to risk and lose and all that stuff, and they assign you a number. And then a portfolio can be built around that number so that somebody who's on retirement income doesn't subject themselves to all these market forces. And that's what a managed portfolio. And so you could either mirror a portfolio or you could have somebody else do it for you. I recommend that you use somebody that should be 1% or less. So Eric does that stuff. Eric's not a money manager. He has other people that they pool lots and lots of money with so that you could have billions of dollars underneath some of the best managers out there. And this is the way that I'm going to give you an analogy. LeBron James is really good at basketball. If I learn how to play basketball a little bit, do you think I'm going to win at one-on-one with LeBron? I might be stupid enough to think that since I learned how to shoot and dribble, and I don't understand how the world of basketball works, I may walk out of that court thinking I'm going to take on LeBron. And he's going to beat my butt all over the place. He'll probably injure me. I once was able to touch the net. I remember that. Right? There are professionals like LeBron James in the stock market world that spend all their waking time and hours doing nothing but trading. If you want to go head-to-head with those people, by all means, it's your funeral. It's not going to end well. Most of the time, people are always like, I'm a great trader. 80% of the time, in my experience, you lose everything. If, on the other hand, you decide to follow what the great traders do, and you get access and you say, LeBron, go ahead and dribble my basketball for me, you're going to have almost guaranteed success. There's no such thing as a guarantee in the world, but over time, you are going to have nice returns. Statistically speaking, it's almost a certainty. If you give it a time horizon, you will be very, very pleased. There are people like that in the financial industry where you give them the rock, you give them the ball, and you say, shoot and dunk. And you pay them a fee. The more people paying them a fee, the less it costs. And that's what, when people are aggregating monies with money managers, that's what they're doing. So you do your 50, your 50, your 50, and you'll have 15,000 sitting up here in your cash opportunity fund. Easy enough? Anybody can do this. Anybody. I can teach anybody to make money.